Davidson Kempner Capital Management is a global investment management firm with over 40 years of experience and approximately $37 billion in assets under management. Employs a bottom-up, fundamental method of investing with an event-driven focus and a multi-strategy approach. The firm invests globally in a variety of credit and equity strategies, as well as real assets. We invest opportunistically across the capital structure and in both public and private markets. Our investment teams collaborate across strategies, asset classes, and geographies. Risk management and preservation of capital are key priorities. We provide bespoke structured capital solutions across a wide range of asset types and industries. DKCM Quantitative Academy is a high-quality investment learning platform that helps students achieve profitability through high-quality services, scientific investment thinking, easy-to-understand teaching, and strong team strength. This class has received strong support from partners and sponsors. In terms of quantitative trading, we have brought together the world's top quantitative talents. We have currently applied AI quantitative trading technology in the global market, helping tens of thousands of investors achieve profit growth. This school sharing class will launch an AI quantitative fund to help everyone grow steadily in value. Existing students continue to enhance their trading capabilities through a combination of learning and practice. We are an independent global investment manager, committed to excellence in everything we do. Our research and investments, investor services, and business operations. Our economic interests are aligned with those of our investors. Our partners, managing directors, principals, and employees as a group are substantial investors in each of our funds. Our highest priority is the best interests of our investors. Our firm rewards people based on merit. The strength and resilience of our people differentiate us and are our greatest assets. Why start the course at this time? 1. Geopolitical risks gradually subside, U.S. inflation gradually decreases, and the Nasdaq index continues to move out of the bull market. 2. The uncertainty of the European election has exacerbated the decline in European stock markets. European funds are seeking global asset allocation combinations, which is conducive to the diversion of funds to U.S. and Asian stock markets. 3. Asian economies and emerging market economies continue to lead global economic growth, and the global emerging stock market contains huge opportunities. Many emerging market stocks have reached a very low valuation area, which is a low point for us to explore value speculation and also an opportunity for our asset allocation. 4. Malaysia's economic recovery has exceeded expectations. The Malaysian stock market has continued to adjust since 2021. In 2024, the Malaysian stock market once again ushered in an upward turning point. The Malaysian stock market is currently in an upward trend. 5. This class is the third global tour course of DKCM Academy. Through the global tour, we are committed to creating a high-quality platform to provide high-net-worth students with broader investment opportunities. We will lead everyone to strategically deploy global stock market portfolio profits, find a group of high-net-worth partners, and further expand the brand position of the Academy in the industry. This time, we will fully enter the Asian market and strengthen the group's strategic deployment in the Asian market in 2024 through live roadshows.
Hello, good evening to all the returning previous student and new student. I am James Lee and welcome back to my live course. Okay, before we start, let's testing the sound and video. If you can see the screen and hear the sound clearly, please give me a response. Just reply with an okay. Great, I see all your responses. Okay, last night the US Department of Labor released CPI data showing that inflation has future cold. So what impact would this have on the upcoming interest rate cut? And what effect would this have on the stock market in the future? Okay, I will provide a detailed analysis in our upcoming class. All right, and a stable value growth strategy has been finalized. So how do we implement it? And additionally, how can we recover losses using the preference share that experienced old student participated in today? Okay, this topic I will be explained in a detail in a class today. All right. So now let's take a look at the stock market opportunity. In these classes, I will convert three aspects. All right. So first is the outlook for US stock following the CPI data. And the second is the latest global capital movement. All right. And the current trends in our Malaysian stock market. So let's go through each topic in details. All right. So we first take a look at our US stock market. Okay, on Wednesday, local time, the U.S. Department of Labor released data showing that in August, the U.S. Consumer Price Index rose by 0.2% month-on-month and 2.5% year-on-year. The year-on-year growth has declined for 5 consecutive months and marking the smaller increase since February of 2021. The August CPI data shows that inflation has future cooled out, with the inflation rate hitting a 3-year low and gradually approaching the Federal Reserve 2% target, clearing the way from a prudential rate cut in the September. And however, concerns about the U.S. economic outlook now outweigh the excitement over the rate cut. And after a strong rally in the first half of the year, with constant new heights, U.S. stock has experienced significant volatility since July. And on Wednesday, after an initial dip due to the CPI data, U.S. stock rebound and achieved a V-shaped recovery, marking 3 consecutive days of gain. And the market has rebounded significant from Friday low. So now only about 2% away from the previous record high. So despite this, U.S. stock market remain unable to surpass the record high set this summer in a short term due to 3 main limiting factors. All right. So first is the geopolitical tensions in the Middle East. The second is doubt about whether the U.S. can avoid recession. And the third is concerns that the artificial intelligence rally may lose momentum. So since the beginning of the year, U.S. stock market growth has been driven by high expectation for AI and Fed rate cuts. And however, investor interest has weakened, and doubt about the sustainability of AI boom have weakened the bullish sentiment on tech stock. And moreover, with the U.S. presidential election approaching in November, market volatility is likely to increase. And from the historically, election years tend to bring greater stock market fluctuation, and investors are evaluating the uncertain political landscape, especially with the latest polls showing that Kamala Harris and Donald Trump running neck to neck and intensifying the uncertainty. While we believe that the S&P 500 remains in the upward trend, it currently faces the key resistance at historic heights. So from all these reasons, we believe that it is unlikely that the S&P 500 will reach significant to the same high in the coming months. And investors may take this opportunity to adjust their portfolios and move assets to emerging markets. So currently, global capital is flowing into the Southeast Asia stock markets that we still keeping to monitor it. All right. So if there is any updates, okay, I will inform to everyone. All right. So is everyone clear on this part of the discussion? Okay, if yes, please respond with okay. All right. So next, we will look at the global capital trends. Okay, Southeast Asia stock markets has strengthened their position as the most favored investment target during the Fed policy shift. And among the top 5 performing Asian stock indices, and fall from this region, all right, with Thailand leading the way. So this wave of buying has seen foreign capital flows into the region for 5 consecutive weeks. And the MSCI ASEAN Index is approaching the highest level since April of 2022. And factor driving investor interest for markets like Indonesia and our Malaysia include the relatively low position held by foreign investors and supportive local policies and attractive valuations. So ASEAN has been overlooked for a long time, but investors are now recognizing many alpha opportunities, such as Indonesia, commodity companies, Singapore stable real estate investment trust, and our Malaysia tech flame, and Vietnam export companies. So a key reason for global funds favor Southeast Asia is the relatively low presence of the foreign funds and providing room for increased investment. So valuations also appear highly attractive with the ASEAN Index 12-month forward price to earnings ratio at 13.6 times compared to the 5 years average of 14.7 times. And recent positive policy move such as financial easing in Indonesia and measure to encounter stock holdings in Thailand and our Malaysia have also been a key reason for this interest. So from banks to real estate developers, this country benefit from high representation in the interest-sensitive and high-yield sector. And Goldman Sachs upgrade Thailand stock rating from underweight to market location this month, while Nomura Holdings rise the ratings from our Malaysia and Indonesia stock. And however, it is important to note that while this is the broader trend, our Malaysian stock market is still in a downward correction in the short term. So why is global capital still following? The main reason is that compared to the US stock market, emerging markets like Southeast Asia offer better value for money, and large funds need to allocate assets. And that's why they are following into Southeast Asia markets. We're looking at the direction of the global capital. It is clear that emerging market stocks are expected to perform well in the future. All right, and we will still continue to focus on these opportunities. All right. So does everyone understand the point I share? Okay, if yes, please respond if you're good. All right. So now let's take a look at the situation in our Malaysian stock market. Okay, after a continuous decline, our Malaysian stock market temporarily rebound today. And however, the strength of the rebound remains very weak. All right. So as large index component stocks are still on the sideline, making it difficult for the index to see significant increase. So today gains are mainly concentrated in the technology stock, utility stock, and the construction stock. The tech and utility stock experienced significant drop, leading to a rebound from oversold conditions. But this is not a sign of stabilization. All right. Okay, when I analyzed our Malaysian composite index yesterday, I mentioned that we are currently in the first wave of this decline, right? Is everyone still remember? Okay, we can understand current rebound as a consolidation pace after the first wave of this decline, or a short-term rebound, all right? And a second wave of decline will follow. So from a timing perspective, the second wave of decline is expected to occur after next Wednesday. So in the upcoming days, our Malaysian stock market will mainly focus on short-term fluctuation. Okay, and for this kind of market movements, we should, okay, what should we going to do? Okay, what should we going to do? I believe that there will be some students don't listen about at my point of view. Okay, but here is a reminder again for everyone. We need to be prepared to reduce our position during the upcoming short-term rebounds. All right, and then increase our stable value-adding strategy portfolio. This is how we're going to step out from the losses. All right, so once the second wave of decline ends and the market stabilizes, we can re-enter at a lower price again, right? Which will lower our holdings costs and avoid losses from the second wave of decline. All right, so the actual stabilization period is likely to be in mid to the late October, all right, with September primarily characterized by fluctuation and corrections. So this year, our Malaysian stock market has experienced a total of 3 fluctuations during the upward process. Okay, so with the first ending from late February to mid-April. So the second ending from late May to early August. All right, so the current third fluctuation starting at the end of August. And this is the reason why, based on the timing circle, the fluctuation correction is likely to end in mid to late October. All right, so during this phase, we will focus on stable value-adding strategy and dynamic growth strategy. All right, like I say, this is how we're going to move forward to the better. Okay, first we will resolve any position through the stable value-adding strategy and ensuring that everyone is unburdened. All right, and then we will look for the better trading opportunities in the emerging markets through the cross-market combination. All right, so is everyone clear on this idea discussed earlier? Okay, if yes, please respond with an okay. All right. So now let's look at the stable value-adding strategy. Okay, yesterday I shared with everyone our operational plan and goals for this season. And I also announced the solution for unlocking preference share. So after the class, I received feedback and questions for some students. And today, I brought in some experienced old students with strong execution and participate in the preference share operation. And new students also want to get involved in the preference share operation. Okay, so how can new students buy the preference share? Okay, I will explain these questions separately shortly. Okay, during my discussion with some students, I found that there was some question. So today I will provide a detailed explanation of this issue. All right, so the first question is, what is the purpose of institutions buying preference share? And why do they temporarily release preference share to ordinary investor with high dividends? Okay, let's take a look at this. Okay, so everyone pay attention here. Okay, because this is to make everyone clear about this. Okay, so there are two main purposes for institutions buying preference share. Okay, so one is hedging and making profit from price differences, and another one is accumulating share. So the first, looking at the hedging and making profit from price differences. When the stock market is not performing well, so how can institutions avoid being affected by falling stock price while still achieving a stable value growth? So in the stock market, there are many investment strategies. Some institutions, they choose bonds, and some maybe they choose money market funds, and some maybe they choose preference share. And particularly for the institutions that are frequently achieved in the stock market, preference share are the top choice. All right. So by negotiating with listed company, institutions, they can receive a stable dividends. And the decline in the stock market does not affect the preference share. And in this way, they can ultimately gain dividends, income, and returns of principal. So if it is foreign capital, they may also gain from foreign exchange differences. And for instance, if foreign investors are optimistic about the appreciation of the ringgit and depreciation of the US dollar, they can enter our Malaysian stock market with US dollar, and after a certain of period, convert back to US dollars, the benefit from the foreign exchange difference. So when the market is declined, buying stock will be typically lead to a losses and being trapped in those stocks, right? Which top institutions will avoid doing. And regarding accumulating share, when institutions operate stock in a market, if the stock price drop in a short term and the current buying cost is high, they might first buy through preference share. And when the time comes, institutions, they can convert the preference share into common stock, allowing for a very quick accumulation of share. So why do institutions, they release preference share with high dividend to ordinary investor? Okay, there are mainly two reasons. The first reason is that as institutions, they leverage their connections and resources to negotiate such opportunity. If ordinary investor, they try to consult with institutions, they will likely be ignored. And the second reason is that when institutions are managing multiple stock at the same time and need to secure another stock, so the fund used to buy preference share are considered reserve. And at this time, they need these reserve funds to support their operation, and leading to a short-term release of the preference share with a high dividends. All right, while allow us to have a channel of purchase. All right. So, okay, up to this point, does everyone understand about what I just shared? Okay, if yes, please respond with a yes. All right. So next, I'm going to talk about what are the channels for preference share. Okay, I would like to clarify that after previous research and conversations through the various channels, after several discussions, we have ultimately chosen the trading platform as our partner. The advantage of this trading platform is that it is currently the best among observed platform. And through this trading account, one can purchase preference share. All right. Okay, here are a few advantages of this trading account. Okay, let's look at the first one. Okay, the first one, you should understand that the contract transaction trading account belongs to institutional investor, while provide significant advantage in operation. So the trading speed and priority of the institutional account cannot be matched by another account. All right. So the second is you can buy preference share. The institutional release preference share primarily on the institutional account, which also help cooperation between institutions. If ordinary investor, they try to approach the large local institutions to buy preference share, they are generally told them that they do not have this opportunity. Okay, why are they telling the ordinary investor that they don't have this opportunity? The main reason is due to the profit concerns. If they were open to all the ordinary investor, it will harm their own interests. And this is the reason why neither foreign institutions, non-local institutions will open these permissions to ordinary investor. And we cooperate as institutions and utilize our connections and resources to create this opportunity. All right. So, and the third is the trading platform allows for the transaction in multiple countries' stock market and preference share, which can meet our diversified trading strategy. And in the future, we will not be limited only to our only in our Malaysian stock market. We will observe global market and participate in whether there are opportunities, while will also help us achieve our 450% of the profit target. All right. So, and fourth is the preference share dividends released on this trading platform has the highest yield compared to another platform I have compared. So if the dividend yield is too low, it will be impossible to achieve a stable growth and help everyone to unlock their position. All right. So, and the last is when negotiating for the better terms, there are still plenty of room for discussion on the discount with this trading platform. And this is why, considering all these factors, we choose the trading platform as our partner. We recommended that to all our students to open a preference share trading account through this platform to help everyone achieve a stable growth and assist students who are in trapping in their inventory. So this will also better enable us to achieve the 450% for the profit target. All right. So up to here, is everyone understand? Okay, if there is anything unclear, you can consult with our assistant after class. All right. So does everyone understand about what I just shared? Okay, if yes, please respond with a clear. All right. So now let me explain the process of buying preference share. Okay, first, you need to have a trading account. If institutions are releasing preference share, they will share the short-term preference share on the trading platform, and the platform will announce the demand. And everyone can choose the preference share they think have a good dividend yield and holdings time based on what institutions share daily. So by using the trading account, you can complete the purchase of preference share with one click, especially during this time, as the stock market continue to decline, and some stock managed by institutions are also dropping. And institutions, they need to reserve funds for urgent situation. They can also reduce holdings costs. So this is willingness to release share is stronger than before. And additionally, the institutions, they have not yet reached the expiration date for the preference share. So they still need some time to accumulate share, all right? And once the market correction is complete, they will withdraw fund from another stock to rehold the preference share. So this is the part of institutions' combined strategy. And we are also taking advantage of this. And when institutions, they have a strong willingness to release preference share in the short term, we can choose to include preference share in our combined strategy to increase a stable return. And I also hope that students can learn to adopt in a market condition and choose the right trading method at the right time. All right. And using our advantageous tools wisely to achieve profit. All right. This is very, very, very important. All right. Okay, everyone, this is really important. That's why I will emphasize that for a few times. All right. So if one day the willingness to release preference share decrease and the dividend yield of the preference share drop, and our combined strategy for hedging risk become meaningless, right? And only with high dividend preference share can we achieve a stable value growth with low risk. And this is the reason why we must use the trading account to have the channel to buy a preference share. Okay, if you want to buy preference share, you must have an account, all right? And I currently negotiating for more benefit for you all, okay? Once our new students are ready, I will guide them into the trading preference share. All right. So do you all understand about what I just shared? Okay, if you do, please respond with a good. All right. Then, okay, why do we choose preference share for our combined strategy instead of other tools? And what benefit does our DKCM Academy gains from this? Okay, let's take a look at this question. Okay, when we choosing the best combination strategy, I observe many investment tools such as option, warrants, bonds, commodities, foreign exchange, and preference share. And the goal of our combination strategy is to achieve a stable value growth while helping students resolve their position. And we hope to accomplish with our 450% profit plan through this strategy, with the premise of low risk, stable appreciation. And we say that option, warrant, commodities, and foreign exchange are all high risk tools with leverage, so which cannot reduce the risk. And bonds are too slow to meet the need for the resolving position. And ultimately, only preference share can meet our requirements. But there are one condition, all right? The yield on preference share must not be too low. And recently, I often receive requests from the institutions that in the industry to help find parties that can purchase preference share in the short term and seeking cooperation for joint marketing promotions. When I was in the US, I often deal with the hedge funds people. And during this time, I learned about many institutions' platform. And in fact, our sponsor is the training platform we discussed. But when we wanted to secure for more benefits for our students, and several negotiations did not reach an agreement. And eventually, we committed to promoting this platform in our Malaysian market and another Asian market to reach an agreement. So to achieve the 450% for the profit plan, we need to use preference share. And additionally, once we reach the 450% profit target, it will be very beneficial for us, because only after we achieve the 450% profit target, can we increase our market visibility? And ultimately, completing our profit target will also lead to profit sharing, which is an important source of income for us. And this is the reason why, whether we have our own interest or helping everyone earn a 450% profit, I believe this is the win-win result and win-win situation. If only the student make money and we have no profit, we cannot sustain our operation, right? And if only we make money and the student did not earn anything, then we cannot continue either, right? That's why this is the win-win situation. And we are confident enough to charge the profit sharing because we have absolute confidence in achieving the target. And we also promise not to charge any profit sharing if we don't reach the target. All right. And in this way, we achieve a win-win situation. All right. So, and now is everyone clear about the previous question? Okay, if yes, please respond with a clear again. All right. So next, I will continue to explain the keys of the preference share. All right. Okay, for the preference share cases, let me use the preference share I operate with the Explain All student today as an example. All right. So there were two preference share in total. Okay, so the first is 8664. Okay, SP Setia with a 5% return in 5 days. Okay, so listen carefully. All right, and 5211 Sunway Berhad with a 10% return in 8 days. Okay, so let's take a look at how much we can earn from these two preference share. Okay, for student A, he bought 100,000 of 5 day, 5% of the preference share. Okay, so and student B, he bought a 100,000 of the 8 days, 10% of the preference share. So now let's see how much each of these students can earn. Okay. Okay, now let's talk about student A first. Okay, with 100,000. Okay, so listen carefully. All right, we will count this together. So student A with 100,000, he can earn how much? 100,000. Okay, 5 day, 5%. All right, so 100,000 times by 5%, which equal 5,000. All right, so they bought it today, and by next Tuesday, all right, next 2 days, they will receive the principal and the remaining dividend. So by then, the total amount will be 105,000. Okay, so here a reminder. After buying preference share, the dividend are returned daily in installments. All right, and the principal and the final day dividend are returned in one lump sum. All right, one lump sum in majority. Even during weekends or public holidays, all right, when the stock market is closed, dividend income will still go into your account. All right, it's still earned. All right, so does everyone understand this? Okay, if yes, we're going to talk about the student B. All right. Okay, now student B. Okay, with same capital, 100,000. Okay, student B can earn 100,000. Okay, 8 days, 10%. So 100,000 times by 10%, which equal 10,000, right? So they bought it today, and by next Friday, they will receive the principal and the remaining dividends. So at this point, the total amount will be how much? 110,000. So when we compare to these two students, okay, we can see that the 8 days return is clearly higher than the 5 day return, right? And the main reason is that the shorter the period, the lower the return. And the longer the period, the higher the return. So just according to your own situation. All right. So if we calculate by trading days, student A experiences only 2 trading days. Why? Because Saturday and Sunday, right? And student B experience a 5 trading day. Okay, so which one is better? Okay, that is depends on your own situation. All right. So the advantage of this method is stabilize and consistently. So if you are looking to earn 10% in a day or 30% in a few days, preference shares are definitely not for you. All right. We treat preference share as a part of a stable value growth strategy. All right. Not only can it achieve a stable growth in the current market environment, but it can also help us to reserve the stock position, right? And for many of our new students who not yet have a trading account, okay, I will continue to negotiating with our partners over the weekend to secure for more benefits, all right, and making it easier for all our new students to experience a preference share operation weekly. All right, so does everyone understand the point I just shared? Okay, if yes, please respond with a good. All right, so now let's see how many times we will need to operate with these 2 preference shares to help everyone resolve their stock position. All right. Okay, let me give an example of how a student with a stock that down 50%, okay, 50% might use preference share to recover. Okay, so suppose Mr. Tan, okay, Mr. Tan has a capital of 100,000, okay, and his current stock holdings has dropped by 15%. So living with him is only a 85,000 in his account. So to recover from this 15% loss, okay, he need about an 18% profit to break even. Okay, this is what I taught you on yesterday. Okay, did everyone still remember? Okay, he need 80% profit to break even. So now, if he use his remaining 85,000 to buy a preference share with 5% return over 5 days. Okay, let's see how many times he need to invest to recover. Okay, so everyone pay attention here, all right? So, okay, first time, 85,000, right? So 85,000 times 5%, okay, equal how much? Equal 4,250. Okay, you can use your own calculator to count as well, all right? So 85,000 times 5% equal 4,250, all right? So now his total is 85,000 plus the profit with 4,250, okay, is equal 89,250. So the second time, okay, use the capital again, 89,250 times 5% again, all right? So equal 4,462.5, all right? So now his total is 89,250 plus the 4,462.5 equal 93,712 ringgit, all right? So, and the third one, use the same amount, use the same capital times 5% again. So equal 4,685.5. All right. So now his total amount is how much? Okay, 93,000 712 ringgit plus the 4,685 equal 98,398. All right. So after these 3 rounds, his total is almost back to the original 100,000, right? With a 5% return every 5 days. All right. So, and it takes about 15 to 17 days to recover. Okay. So now, if he used the 85,000, okay, the situation is same. Okay, the capital is also the same, right? 85,000 to invest in preference share, but this time is the 10% return over 8 days. Okay, so let's see how many times he need to invest. Okay, first time, 85,000 times with the 10% equal 8,500, right? Okay, and now his total amount is, okay, 85,000 plus the 8,500 is 93,500. Okay, and the second time, okay, use the same capital times the 10% equal 9,350. So now his total is 93,500 plus the 9,350 equal how much? Equal 102,850. So after just the 2 rounds, not only does he recover his original 100,000, right? But he also gained an extra, the 2,850. So the 2 rounds take about 16 days, all right, which is similar to the time needed for the first method. But the return is higher with the 10% option. And however, preference share with higher returns, like the 8 days 10% option, are in the high demand. So the share might be quickly sold out. So to keep in mind that the available shares are limited. All right, institutions only release what they need, and extra shares are not made available for the purchase. All right, so it is important to reserve share in advance when investing in preference share. All right, so does everyone understand the explanation? Okay, if yes, please respond with a yes. All right, so now let's move on to discussing growth and learning section. All right, so in the previous classes, I also share with everyone the 4th best entry points for accumulating stock, right? So although I think it is relatively simple, but it seems that some of you found it a hard challenging during the learning process. So, and however, what makes me feel happy is that everyone was very focused on this. And I can see and feel that. And I'm really happy to see all of you putting in so much effort. So it is okay if you don't understand anything, everything, or you don't just can remind our assistant. All right. So when you are unclear with anything, so make sure to write down your question and share them with our assistant. Okay. And I will help you to review and reinforce the knowledge so that it will become yours. All right. So today I will give a brief explanation about the purpose and reason behind institutional shakeout. All right. Okay, shakeout refer to the behavior where institutional investor, after they accumulating a certain amount of the share, suppress the stock price in order to reduce the number of followers before officially driving up the stock price. or even during the price increase. So everyone need to be aware, okay, aware that the shakeout can happen not only during the accumulation phase, but also during the price increase phase. So this is similarly, accumulation doesn't only occurs at the low point. So after it's shake out, there will definitely be future accumulation, but the amount varies. All right. So the most accumulation happens at the bottom, while shake out after price increases occurs because the shares sold during the shake out need to be bought back to stabilize the stock price. And accumulation happen in this context. All right. So now, looking at the chart, the shakeout happened in the middle of the upward trend, which is similar to a continuation pattern. All right. So did everyone hear this clearly? Okay. If yes, please respond with an okay. All right. So now let's look at the purpose of institutional shakeout. Okay, for the institutional investor, as we call it major player as well, okay? So during the process of driving up the stock price, they need to continuously attract external funds into the market to create a steady flows of the exchange. Okay, this is not only reduce the resistance to the price increase, but also provide a boost to the rise. All right. So the purpose of driving up the price is completely opposite to the purpose of accumulation. So during the accumulation, they create a panic in a hope that retail investor will sell their share. So we will have to aware from here. All right. So don't fall on this trap. Okay, they create. All right, is everyone understand? So, and in another hand, during the price increase, they create a strong position effect to attract retail investor to enter to the market. So, and this is the reason why the rise in a stock price doesn't mean that the institutional investor are consistently using their own funds to push the price up. And a rise without retail participation is meaningless because without retail investor, even if the price reach the top, okay, reach the highest place, but the institutions, they cannot offload their share since won't be the no buyer. All right. And this is why when institutional investor drive up the stock price, they must attract the external followers to join in the process. So this is how they could push the price up. All right. So, and this explains why this is often higher than around certain teams in a market, especially in the Asian market, where the team-based speculation help gather retail interest. So this is to attract the retail investor interest. And institutions, they initially use their own fund to lift the stock price. And later, they rely on the price increase along with the position news or the meta speculation to guide retail investor to active participation. So, and in this way, when the price reach in a high point, okay, they can smoothly sell off their share. All right, so gathering external interest is a key method for driving up the stock price. Okay, and it is important for everyone to clearly understand what the institutions are trying to do. Okay, like I mentioned just now, okay, we must be aware. Okay, don't fall on the trap they create. All right, we have to know when to going to enter and exit in a market. All right. So does everyone understand this? Okay, if yes, please respond with understood. All right. So now I will share with everyone the reason behind institutional shakeout. Okay, everyone should understand that there are several important reasons, okay, why institutional investor they carry out shakeout. Okay, so please listen carefully here, all right? There have a few reasons here, okay? I have already listed out with the important point, okay? So let's look together. Okay, the first reason is sometimes clear out the share held by retail investor who have made profit, and by reducing the amount of profit-taking share instead, and the resistance reduce, the price increase is lower. All right. So the second reason is to attract new retail investor, and some funds outside the market are on the sideline, waiting for the stock price to pull back before entering. Okay, so at this point, after the institutions shake out some of the profit-taking share, the external funds can become the new entrants and helping to push the price higher. So the core of market influence is to create a unified momentum for this price rise. And more unified is that the more favorable it is the stock price to go up. And shake out in the media create a short-term divergence. But once the new funds enter, unity is resolved. And this could be triggered by positive news or dramatic speculation, and all aim at maintaining unity. And in the stock trading, achieve a collective strength and show success. All right. And the third reason is to make a profit by selling high and buying low. So institutional funds are not kept in stock without movement, but are rolled over. So during this shakeout, they use a small portion of fund to buy a low and sell a high, and reduce their average holding cost. And over the time, for long-term institutions, their costs become significantly lower through this operation. All right. And the fourth reason is to adjust their portfolio structure. And some institutional investors, they stagger their trades. Okay, for example, one stock may be in an accumulation pace, while another has entered the price increase pace. So at this point, the institutions will adjust the portfolio through the shakeout. All right. And the fifth reason is to adjust the capital ratio. As the price rises, the institutions need to gradually reduce the proportion of funds invested. All right. So during the process of reducing position, shakeout is very occurs. All right. So is everyone understand the total 5 points here? Okay. If yes, please respond with a yes. All right. So now let's take a look at the different position where shakeout occurs. Okay, everyone should understand this. When we study this aspect, you need to know the institution's starting point. All right. So in stock trading, starting retail investor participation and the level of profit-making pressure is a must for institutional investor. If they don't study this truly, they won't be able to manage the risk. And the main purpose of the institutional shakeout is quite simple. All right. So to clear out this profit-taking sharing from following retail investor is to attract a new retail investor who are optimistic about the future market. All right. So first, when do institutions they carry out shakeout? Okay, this is something everyone must know. Okay, shakeouts are closely related to the level of retail investor participation and the amount of profit-taking pressure in the market. And when the market interest reach a certain point, institutional investor, they will start a shakeout because the interest must be kept within a certain of the range. So it is not that more interest is always better, but there are too much, and it could lead to a profit-taking pressure and creating a resistance to the future price increase. And this is the reason why it is important that to know where institutional they will carry out the shakeout. And during an upward trend, institutions they often perform a shakeout in 4 key areas. Okay, so what are the 4 areas? Okay, everyone have to pay attention here. All right. Okay, the first area is in places where retail investors are not strongly willing to chase rising price during an upward trend. All right. So the second area is in area where the selling pressure from retail investor profit taking is too high during the price increase. All right. So the third area is after a small buying spike during the price increase. All right. So and the last area is by using previous resistance levels for shakeouts. Okay. So due to the time constraint, I will explain this institutional shakeout area in detail in the next classes. All right. So everyone can be better understand the concept. All right. So is everyone understand this? Okay. If yes, please respond with an okay. All right. So now let me assign the classwork for today's class. Okay, today's lesson teach everyone how to identify some of the technique used by the institutional. It is essentially to understand their objective, right? So you don't get stuck in the stock market. And sometimes the stock may be already be a high point. Okay, so we need to observe if there is a suitable opportunity to entry. Okay, so if there is anything you are unsure about, okay, you can contact to ask our assistant to check it out. All right. So today's class assignment we have 2. Okay, the first is what are the reasons for institutional investor shakeout? Okay, so the second main area is where institutional investor carry out shakeouts. Okay, so when you're done with the class assignment, so please submit to our assistant. All right. So, okay, everyone, today's class is going to end soon. Okay, today's class, I had provide a detailed analysis of the outlook for the US stock market, our global capital flows, and the current pattern of our Malaysian stock market. And here is a reminder again, all right, the stable value adding strategy has been established. So, and we will gradually involve students in the operation and layouts. And currently, there are not many spots or allocations for preference share. So we will continue to negotiate with the partners over the weekend to secure for more allocations and preference shares. All right. And additionally, we will try to obtain, gather a discount for our new student. All right. So please wait for our notification. All right, and be patient. Okay, so that concludes today's class. I will see you guys soon. All right, so bye-bye.